Alright, now having understood how you buy shares in a primary market, let us try and understand how a trade happens in the secondary market, that is through the stock exchange. Now, when you want to trade in the secondary market, then there has to be a buyer and there has to be a seller. A buyer can buy only if somebody is wanting to sell, and a seller can sell only if somebody is wanting to buy. Alright? So the buyer would require a bank account, a trading account, and a demat account. These three accounts are required. Similarly, a seller would require these three accounts. Alright? In the secondary market, it is not possible to buy and sell shares unless the buyer and the seller are holding these three accounts. Let us see what is the purpose of these three accounts. The bank account, as you all know, would reflect the amount of money held by you. How much money is held by you, that is reflected in your bank account. And in the demat account, it reflects your stock portfolio. What shares are you having and of what company, what quantity, all those things are reflected in your demat account. Alright? But then how do you get connected to the stock exchange? Your bank account and the demat account are not connected to the stock exchange at all for the buyer as well as the seller. Alright? They are not connected to the stock exchange. Then how do you connect with the stock exchange? You connect with the stock exchange through your trading account. And that trading account is also through your broker. You are holding a trading account with your broker. You are not directly connected to the stock exchange. Alright. So what does the trading account do? The trading account connects the buyer and the seller to the stock exchange through their respective brokers. Alright. Now, so when the stock exchange opens in the morning, or in fact, even before the stock exchange opens, the buyers and the sellers would have placed their respective orders on the stock exchange using their trading account through the brokers. So the buyer would have placed their buy orders and the sellers would have placed their sell orders using their trading account through the brokers. Alright? And then there is a separate queue in the exchange, electronic queue, for every share. There are thousands of companies listed on the stock exchange. Each company or the shares of each company would have a separate queue. And even for each share, there would be a separate queue for different prices. Alright? Now let us say when the stock exchange opens, immediately at the opening bell, the stock exchange software will check as to who is wanting to sell a particular share at the lowest price. And then if at that lowest price there is a buyer, then the stock exchange will match the buyer and the seller and the trade will get executed. And the price at which the trade gets executed becomes the market price. For example, let us take a particular share, let us say Tata Motors or Tesla, whatever. Suppose somebody is wanting to sell at $10.5 per share, and that happens to be the lowest price, and there is somebody who is wanting to purchase at that price. So the trade gets executed and this $10.5 becomes the prevalent market price at that moment. Alright? And as long as there are buyers and sellers at that price, the trading will continue at that particular price. Alright? Now imagine after a few moments, say there is a seller at that price, $10.5, but there are no buyers at that price. The next buyer is available at $10.4. Nobody is wanting to buy at $10.5, though somebody is wanting to sell. But if there are no buyers at that price, the trade cannot get executed. So the exchange software will check whether there is any seller in the queue wanting to sell at 10.4 because there is a buyer at 10.4. If there is a seller available at 10.4, then the trade will get executed at 10.4 and then 10.4 now becomes the market price at that moment. Again the trading will continue as long as there are buyers and sellers at this price, 10.4. Now let us say after a few minutes, say there are buyers at $10.4. People are wanting to buy at this price, but there are no sellers. Nobody is wanting to sell at 10.4. Between 10.4 and 10.75, there are no sellers. The next available seller is at $10.75. Alright. So what the exchange will do? The exchange will check whoever is the first buyer in the queue at 10.75, the next available price, the trade will get executed. So after this 10.4, the next trade which gets executed is at 10.75. And since the trade has been executed at 10.75, the market price becomes 10.75. Alright. And it will continue at 10.75 till the time there are no buyers or no sellers available at that price. Alright. That is how the price will keep fluctuating throughout the day. Now let us see what happens. Once a trade is executed, then the money from the buyer's account will go into the seller's account. The one who has sold the shares has to get money. So money from the buyer's account will go into the seller's account, and the shares from the seller's account will go into the buyer's account. Alright? And both these persons would not know where the share has come from or where the share has gone. It is done by the exchange, and the exchange does not normally disclose that. Now remember that this transaction of money going from buyer's account to seller's account and shares going from seller's account to buyer's account does not happen immediately. The exchange takes some time to settle that account. Normally that time taken is T plus 1, that is trade day plus 1 day, that either it happens on the next day or it may happen on the next to next day, depending upon which country you are trading in. Different countries have got different time periods for settlement. In India, it is T plus 2 at the moment. But in different countries, in some countries, it may be T plus 1 also. In some countries, it could be T plus 3 also. Alright. So I hope you have understood as to how a trade happens in the primary market as well as in the secondary market. Alright.